Hey folks, we're glad you could join us on Business Redefined, your weekly most comprehensive look at the world of business, finance and economics. We are on the HY2026 numbers and Absa Bank is the latest kid on the block with the earnings, and we're privileged to have the interim MD and CEO. That is my good friend, Yusuf Omari. Yusuf, karibu sana.
Thank you. Thank you so much. And thank you for having me here again.
Anytime,
and
Yusuf.
As usual, every time we release the results,
we pick up from where we left.
We continue.
And congrats, Yusuf, once again.
Thank you.
Yusuf, I have a challenge with your earnings. Margins compression is real. Your NFI book, the defensive play, did not kick in good time to countervail the pressure you're facing on the funded side. How do you respond to that, Yusuf?
I think for me, I always say about 70% of our revenue is driven by rates. It's a balance sheet. And so if you have a drop in your interest rates, then expect to have that impact in your financials. Of course, the other interventions you can be able to put. And so for me, every time we compare year on year, that number must be adjusted with what was there, the environment, the operating environment that was there 1 year ago. And this is exactly what is happening. Now, we've had two unique periods, 2025 compared to 2024, sharp drop in rates.
Correct.
And then the last period now will be 2026 compared to 2025. If you look at interest rates back in, let me say November 2024, 6 months T-bill was at 16%.
Yeah.
Come Q1 2025, that rate went down, not to the current levels. And so we repriced our portfolio all the way to around June.
Yes.
And so when we now start looking at the rates that are operating at this point in time, it is what was evident in Q4 2025.
Correct.
So it's not like for like. There will definitely be a time where we have to rebase.
Yeah.
And that rebasing for us will come in Q4 this year. That is when we'll be comparing quarter on quarter.
Yes.
And so the impact that you're seeing on our revenue, it is us extending those drop-in rates to the customers.
Yeah.
So the customers are happy. We've picked a hit on an average of about 150 basis points. However, on the deposit side, we've cushioned that. We've dropped our cost of funds by about 100 basis points to now about 2.8.
There you are.
It's among the lowest cost of funds in the industry, among the lowest.
Yeah.
So we've literally stretched it completely. The only time now you start seeing our financials picking up is we now start comparing similar macros, which is what I'm talking about Q4 of this year.
But Yusuf, on your deposit play on that side, two things there. One of the things I struggled with when I looked at your numbers, and I'm impressed by the cost of funds, but equally, your loan to deposit has ramped up and ticked up towards the 90%, I think about 88% now. To what extent can you take advantage of this cost of funds? Because, as you said, macros will be macros.
Yes.
Yields will be what they are.
Yes.
But then you still have to ensure that your bottom line is performing.
Yeah. I think what I like about our deposits at this point in time, about a year ago, our transactional deposits as a percentage of total deposits was around 65%. Today that has changed. Now it's about 75%.
Yeah.
Which means our deposits has picked up 5% year on year. But then if you look at the drop in deposits, the category that has come down is TDs, is term deposits. Our transaction deposits has picked up 18%. So we are reaching a level which was there about 2 years ago. It's more sustainable, and we can be able to progress on that one. Now, when we are advancing, facilities to our customers, I know we are looking at the metric of loan to deposit ratio.
Yes.
But remember, as a bank, we keep capital. So that loan to deposit ratio does not mean that you've exhausted your funding. The funding is still there.
Yeah.
And then, of course, other sources, if we are injecting, capital, tier 2 capital, all of that will be able to help. I think what I like for me is we've changed the structure of our assets with now about 60% of our balance sheet being advances to customers. That does two things. One, of course, it supports a better margin than, for example, investing if assets are in government securities. And the second one for me, and which is more fundamental, is while you support your customers, then it means your customers' product holding will increase.
Yeah.
Because a customer will come and take a loan with you. They will, of course, have a deposit with you. And then through that, they will take another one or two other products.
Yes.
You might find they might take an insurance product for you. And what we shared today, product holding for customers has increased to about 3.2. So they're doing more businesses with ourselves.
Yeah.
And come Q4, and as we progress, we rebase the rates, it will be very evident when you look at our financials.
Yusuf, one of the questions which in the last MPC briefing I asked the governor was, isn't he bothered as to what the T-bill yields ticking above the CBR means from a transmission perspective, because now we all adopted a harmonized benchmark. Many banks are leaning towards CBR. Does that concern you?
It's an interesting question because the opposite happened as well, where T-bill was significantly lower than CBR.
But that helped you with the deposits.
It helped with the deposits,
yes.
But what about on the side of lending?
Yeah.
You know. So I think we have to appreciate that the new pricing benchmark, CBR or Kesonia, it's not even 1 year old.
Yeah.
It was effective 1st of December 2025. As we progress, we should see that difference really narrowing down. It's only that effective 1st of December, there was that big difference. And the promise we got from the regulator, from the governor, is over the period, you see that coming down and the differential will reduce. Okay. So whether you are, banking on the side of deposits or on the asset side, it will be indifferent.
Yeah.
Yeah. And so for me right now, I think it's a natural thing that is picking up, depending, of course, on the environment that we are in.
Yeah.
And I'm sure the industry will really want to see the two really coming together so that you don't have a significant variance.
Yusuf, let's go back to the income statement. One of the strategic imperatives of this horizon you are in, which I think ends next year, was about revenue diversification. When you look at the HY numbers, do you feel your new revenue lines, AML and the custodian, etc., are beginning to take a significant proportion of the revenue pie?
Yeah, I'm so impressed. If you look at our NFI and exclude the FX and trading margin, which again, it's a good story to the environment. I mean, to the economy. If you have an exchange rate that you can be able to predict and is stable over the period, it's a very good environment as a business person. But then, of course, with that one, depending on what was there previous years, of course, then you get a hit. But that aside, excluding FX and trading revenue, our NFI has picked up 9%.
Yeah.
In there, the new businesses growth year on year is over 20%. And this has been in that same trajectory every time when we release our results. So our bank assurance business growth over 20%. Our asset management business, same thing. Our securities and custodies, while the custody is still at infancy rate, it's really picking up, and you can see, and when you look at your assets under management, those ones are picking up. So I'm glad we took this bet.
Yeah.
We started the new subsidiaries. We've supported these subsidiaries with capital. We've put a lot of resources in terms of on the staff side, on systems, and all of these are starting to come through. And so the beauty with the new revenue streams is you reduce your reliance on the balance sheet. It also gives your customer a holistic array of services, because a customer now can decide, I want more riskier products. I don't want to go through the traditional deposits, term deposits. Can I put it with your asset management? And they can go to money markets. They can do, depending, of course, on their appetite, they can now be able to have an array of service that is available within the bank. And as a result of that, you've seen the product holding picking up.
Yes.
Yeah.
Yusuf, one of the bright spots in these numbers is the asset quality. Never mind, already you are among the best in class. Are you fundamentally seeing recoveries? Are you seeing an improvement in just repayment given the evolution of the macros? Is it a mix of both? What's at play here?
It's actually a mix of both. So the one that is evident is stability on the macros comes through. We've seen rates coming down. It's now becoming more affordable, especially if you look at the personal household sector. It's now more affordable. And customers now are able to convert from a non-performing book. A customer comes in, I don't want to be listed. Here is what I owe you. If anything, they're even taking more. And so the performing, you're now having more of the performing book from that sector. The others, of course, which were not performing, of course, there were recovery efforts that were taken through. And through that, then, of course, you can be able to see them in the financials. But for me, I think what is fundamental, and we've seen this with Absa financials, whenever you look at the asset quality, it's always one of the best in the industry.
Yeah.
It goes with the fundamentals of lending. Maybe
also a risk posture.
The risk posture could be there. The risk posture could be there. No, that's true. The risk posture could be there. But we're open to business because if you look at the risk posture, then your loans and advances will not be picking.
Yeah.
It's picking.
Yeah.
So it's picking as long as that is picking, then it means you're taking risk, but then it's a calculated risk. So you are lending through the fundamentals of your risk management policies. And through that, then you can be able to see with the quality of the book.
Yeah.
Now, you never know how bad a book is when the macros are stable. It's only when you get a spike there that then you get to know who was swimming naked.
Yeah.
The tide has come down and then that comes out. So for us, even during the time when the macros, were quite tough, the quality of our book has never changed.
Yeah. And maybe that explains also why even in the HY2026 numbers, your provisions still reflect what I could say is cautious perspective in terms of what could pan out in the market.
I think if you look at our provisions, we've seen improvement. Our loan loss ratio now is about 1.9. Within our appetite is about 2.2. So still within the appetite. What we have seen is an uptick, especially for the corporate business, significant uptick on the lending side. Our corporate business, traditionally, the loan loss ratios are very, very low.
Yes.
So that doesn't trickle into that number. We've seen our consumer business. That is starting to peak, especially in quarter two. So lending also in that front is peaking. And then now our business banking business is catching up on that front. So from holistically, if you look at that impairment number, a big impairment number, and this one I'm looking at in the banking industry, you see a big number will always come from the retail and the SME side, and then to a very low extent when you look at the corporate business.
You had some one-offs in these numbers, Yusuf. If you could speak to them, that is the voluntary exit and also the digital investments, I think.
Yeah. So we've done a lot of investments on the digital front. If you look at technology over the years, significant investments always keep on going, especially to do with automation. You've seen our automation coming from about 45% of our core processes to now 71%. Where we've been able to automate our processes, really following customer journeys and saying, how can we be able to automate the process? So through that, we found ourselves with surplus staff in back office. So we did two things. One, of course, is to be able to see whether you can redeploy them to customer facing, which mainly is on the side of sales. And then we also took that opportunity to do a voluntary exit program. And in January, we were able to conclude, on the exercise, and you see those financials, about slightly more than 700 million shillings hitting our number in Q1. So that's a big one of that has come through. But I think for me, what is interesting is our efficiencies are improving because of automation, because of alternate channels. And through that, then we are able to drive efficiency. Staff cost is the biggest cost, for a bank. And so if you can be able to automate a process there or give customers alternate channels, then your efficiency will definitely be able to come through. And hence why you're seeing our cost-to-income ratio is among the lowest in the industry.
but this time it has ticked up to the early 40s.
You know,
I've always asked you.
Let me tell you, this question always comes up. So when it goes to 36,
It's a problem.
it's a problem. Why are you not invested? When it goes to 41, 40, I think it's a good level to be. Don't forget, from a strategic point of view, our appetite is to have our cost-to-income ratio to the low 40s.
Yeah.
So it is 40, 41, 42.
So you're pretty much there.
We're still okay
Yeah.
on that one. The minute you get concerned is if you now start going to 45, 50, then it means you're becoming less efficient. Also very low means maybe you're not doing the necessary investments. I'm very comfortable with low 40s.
Okay. Yusuf, First Assurance, what's happening there?
Those questions have come up. I thought they were not, they're not going to be brought even on the floor when we were releasing the results. I think when I look at our insurance companies, and this is from a group perspective, remember the clarity we give is that both the insurance company, the General and Life, First Assurance and Absa Life, are owned directly by Absa Group and not Absa Bank Kenya.
Correct.
So no ownership structure, although we say it's our sister company. Group has made a decision to exit on the manufacturing side of insurance and really focus on distribution. Now, distribution is our bank assurance business. It's doing extremely well. It's within our core business. And the beauty with that, then, it means we can partner, and we have been doing that. We have been brokering for our sister companies, but also other insurance companies. Remember the legislation in Kenya, if you're a customer in Absa Bank, and you want to get insurance services, we cannot dictate to you which insurance company to go to. So what we'll do is we'll give you a list of the insurance companies that we've already signed partnership agreements with, and we'll take you to whichever insurance company that you want. Remember, at the end of the day, you as a client, you are taking insurance, you've done your own due diligence, and so you're making that call. So the bank cannot make that decision for you. And so it follows that from an Absa Group perspective, to make that decision to exit manufacturing and focus on distribution. 3 countries have already exited that market. That is Botswana, Mozambique, and Zambia. Okay. So Kenya is the 4th one.
Yusuf, I'm told our time is fast spent. Let's close this. A pleasant surprise on the interim dividend, 150% up. Two questions there. One is that, is this a signal, subject to performance, of what we should expect on the final? And also, just walk us through how you arrive at that. Yeah.
I think if you look at our policy, dividend policy is to pay 55% payout ratio for your profit after tax. So we've been able to do that in the past. So it's a general guidance in terms of the policy that we follow. However, we put caveats there. We do a lot of stress test on our profitability, especially when we do our medium-term planning. We do that for 3 years going forward. We look at our profitability. We look at the macros extreme, because it's a stress test. We look at significant growth, for example, in your risk-weighted assets. Those dictate how much capital you need to hold. And so through that, you might find the 55% can be 45%. Yeah. It can be 49%. Last year was 49%. It could be 60%. So 55% is a guidance subject to the stress tests I've mentioned. But the beauty, if I am an investor, I know profit after tax, 55% comes to my pocket. Yeah. That's the beauty, because with then our investor, they can be able to plan around that. I've mentioned the capital ratios, very healthy. Yeah. And so with that, we see it is sustainable for us to be able to increase the interim dividend to the 150% increment that we've been able to do that. There's an element of consistency that we follow when we look at our policies. While our policy speaks to 55%, we also try to be consistent so that come subsequent years, you don't see a drop. Yeah. That level is established, it's sustainable, and we can be able to replicate. So that's the confidence I can give you whenever we are declaring dividends.
Just a final question, and I've asked you this question before. Let me just seek an update. Have we had any conversations about the opportunity in Addis?
That has been held. We've held those discussions in country, and the discussions have also been held at group level. And it's one of the markets that is quite attractive. We've seen quite a number of banks dashing to Ethiopia, opening representative offices. That is one of the top agendas that group is considering. And at the right time, I'm sure we'll be able to come and communicate that. But it's an attractive market, and it is under consideration.
We've been having a conversation with Yusuf Omari, interim MD and CEO at Absa Bank Kenya, focusing on HY2026 numbers, income statement, balance sheet, the dividend, and finally growth prospects across the region. We shall keep you updated on the latest as and when they unfold. So keep it Business Redefined.